Well, great to see everyone. Good morning. It's 7 a.m. over here in San Francisco. It sounds like most of you are on the East Coast. So I am on my second cup of coffee, trying to catch up to you guys this morning. But I'm happy to be here. And I've enjoyed doing events with Scott in the past. And it's like he has such a heart for teaching and such a heart for giving. That's the same as a lot of speakers you guys are going to see for the next 3 days. And so I'll tell you a bit about my story, and then we're going to talk about syndication structure and due diligence. And these are excerpts from what I teach my investor base. So I'm a syndicator. I have about 10,000 investors that I teach this model. And I'm not going to go into like how to do the numbers on a deal. I know Scott does that in some of his masterminds and stuff like that, but more like the concept of how do you choose what's right for you? Because especially today, today is all about investment options. You're going to hear a lot of things. And how do you decide what's right for you? That's actually part of your due diligence process as well, not just making sure that, it's not a scam. You need to make sure it's right for you, because there are so many good investments. People always ask me, is this a good investment, Sarah? I'm like, well, it depends on your goals. It depends on what portion of your portfolio you're thinking of investing into this. Is your net worth 1 million? Is your net worth 10 million? Is 100K minimum investment appropriate for you? There's like so many things to consider. So that's what we're going to talk about today. I will kick it off by saying I appreciate that this is meeting style, so I can see you guys. I would love it if you guys use the chat while I go, because I don't know the audience very well. So like Scott said, like if something's important and new, let me know. If something's like, hey, we know this, let me know, and I'll fast forward through that section. So I'm going to go ahead and share. Question for you guys. Who here knows what a syndication is already? Put syndication in the chat, please. I would appreciate that. In the chat, let's see. Who knows what a syndication is? We got one. We got three. Okay, three out of you. Okay, so how about this then? Does anyone not know what a syndication is? Okay, so great. That is very telling. So I won't spend a lot of time on what the structure looks like, but I'll spend more time on due diligence and how to choose what investment is right for you. Okay, cool. So some of you don't know what a syndication is. That's great. We'll touch on it briefly. All right. So you're all here because you want to do what the wealthy do, right? That's why we're here. That's why we are spending 3 days together. And I want to let you know that my journey began in an event just like this, 3 days learning from experts and figuring out what was right for me. So what do the wealthy do? They earn more, they keep more, asset protection, tax strategy, and they grow more, picking wise investments for their goals. So that's what you're doing here over these 3 days. So like Tammy said, Suco Capital, we connect investors to passive income opportunities. So we have about 450 million in assets that have been acquired, and they've all been in syndication style apartment buildings. We've acquired 22 apartment complexes across the United States, none in California, mostly Sunbelt, Texas. And we had 6 exits, and the average annualized returns for investors across those 6 exits was 33%. This is something I'm very proud of, because most people who invest with us, they're using their IRAs, their 401ks. This is something that they're building as part of their legacy or as part of their retirement. So I feel very honored that they trust their funds with me and that I'm able to give them a great return. All right, so today we're going to talk about 15 ways to make money in real estate, how to choose what's right for you, how to double your money with no work, financial models, some terminology, which I'll go quickly through because I think a lot of you know most of the terminology, and then how to do due diligence on investments. So normally people do it backwards, so I'm going to teach how to do it forwards. All right. So my results. This is a before and after picture at the beginning of my real estate journey. So normally the before picture is the trashed photo and the after is the nice, pretty photo. That wasn't with me. I got a turnkey duplex in Indiana. And I was like, oh, if it's the 2% rule, I'm going to rock it. I'm over here in California. Well, I didn't do enough due diligence on the property management team. I didn't do enough due diligence on the tenants they were putting in my property. And so I didn't get rent. The place was trash. Their dog tore up the beautiful banisters. I ended up selling it at a loss because I couldn't easily get there. It was 2 flights to get over there, and it wasn't worth it for, a 75K property. And so that kind of investing was not right for me. It's right for other people. So it depends on where you live, what your goals are. That was not right for me, but I didn't stop there. And I tell this story not to brag, but I tell this story to say, don't stop. Just because one type of investing might not work for you, it might work for your neighbor. You might need to find something else that works for you and your goals, okay? So fast forward, I tried over 15 types of real estate investing, and I settled on hotel developments, multifamily developments, and multifamily syndication. And so now I earn passively 18 to 25% on my investments. And so then I started telling friends and family, and I transitioned from being a W-2 earner and a passive investor in these types of opportunities, to switching over to being on the active side, to being on the GP of syndications, which is where I am now, and I no longer work a W-2 job. And so again, this chart is not to brag, but this alarm clock was a point in time when I started attending things like this event, and when I started setting very, very clear goals. My goals were not like, oh, I'd like to retire early. My goals were like, by the time my daughter is in 3rd grade, I want to replace my W-2 income with passive income from real estate. And so I started setting super, super clear goals. It was, at the very beginning of 2018, and then everything skyrocketed. I started absorbing things from same speakers you're going to see over these next 3 days and applying them to my life. So I really want to reiterate, applying things to your life and taking action. Otherwise, it's just a waste of 3 days for you and for the speakers, right? We want to change lives. That's why we're here. So what is the first step in investing? In that grow section of earn, keep, grow, to be wealthy, you need to decide what kind of investing is right for you. This is your first step in due diligence. So, like I said, the single family home investing, duplex investing in Indianapolis, not right for me, great for others. So the first step is vision. So what type of passive income do you need, or what net worth do you want? So when you're investing, are you investing because you want to quit your W-2 job this year? Then passive income is going to be really important. Are you investing because you want your IRA to double in the next 5 or 10 years from when you're retiring in 5 or 10 years? Okay, that's going to be a very different investment strategy. So you have to think about your vision for your life and then set your investment goals to match that, which I know Scott does with all of you, so that's perfect. But for anyone new on here, I want to say that is the very first thing. When I have conversations with investors, we start with vision, because there's all kinds of great investments. It just depends on when do you get the money, what's the level of risk, what's right for you. So you also want to be really clear with yourself, what level of effort do you want to put into your investments? Because there's a lot of things that are called passive investments, which are not actually passive. Excuse me. Different things take different amounts of time. And so you really want to be clear with yourself. How much time do I want to dedicate to either learning this investment style, learning this craft? Because if you are hands-on, you need to learn. You need to be a professional, right? Like you need to level up the amount of knowledge. You need to spend the time learning. You need to spend the time having a coach. If you're like, no, that's totally not interesting, then go for a passive, totally hands-off investment. These are really important things for you to be real with yourself about. Level of risk, don't just look at the returns. Decide first what level of risk is palatable to you before you start exploring investments. And then next, set the goal. So the vision and the goal are tied, but the vision, it might be, kind of fuzzy. Goal, set interim goals, dates, and then who do you need to tell? This is really important. So do you need to tell your spouse? Do you need to tell your boss? Do you need to tell your business partner? Be really, really clear together. before you start investing, and you can keep each other accountable. All right, disclaimer, there are risks associated with investing, including principal loss in all types of investing. So don't listen to anyone who tells you, hey, this is a guaranteed return. Now, debt and equity are different, but just know that there are risks associated with everything. And the numbers I'm going to show are not offers to invest in these things with me. Okay. So we're going to look at really quickly 15 types of real estate investing on the basis of ROI, cash flow, level of effort, risk, money needed to get started, and hold period. And then I'll focus on syndications. So the reason I talk about annual ROI and cash flow, making sure it's really clear they're separate things, is because in that first step on vision, when you're thinking about, do I need monthly cash flow? Do I need quarterly cash flow? Or is this something in my IRA for 10 years from now? If you're investing for today or in the next year or two, you're going to focus on investments that give you cash flow, right? If you're investing for the future with your IRA, you don't care about cash flow. You're going to want to maximize your annual ROI, and different kinds of investments are going to do that for you. Hold period is the last thing in the chart I'm going to show you guys, but it's really important because when you're investing, you want to know what's liquid and what's not liquid. So syndications, what I do, they are not liquid, meaning everyone joins together and everyone exits together. So if the hold period is 5 years, you cannot access the 100K you put into that apartment complex syndication for an event. So I always give this example of, if this 100K is kind of the nest egg that you're investing for your kids' college and they're going to college in 3 years, do not invest in something that says it's a 5-year hold period. You cannot trade out of it. Single family home, Airbnb, those hold periods is up to you. So those might be better investments for you if you need liquidity in your investments. So really be clear with yourself if liquidity is important before choosing the type of investment you're getting into. Okay, so in the interest of time, because I only have 15 more minutes, right, Tammy? I'm going to say, look at all the things you can consider. There are so many things. There's single family home rentals, there's duplexes, there's land flipping, there's house flipping, there's hotel development, there's private lending, which is super cool and flexible for those of you who need flexibility. Apartment syndication, what I do, ATMs, Dave Zook is on here. He's going to talk about that. My fund invests with him. I have 2 funds. Storage unit syndication, super great right now. Mobile home parks, mobile home rentals, individual, commercial retail parks, medical office parks, private real estate funds. These are all things you guys in this call can invest in. And so getting clear with yourself, is ROI or cash flow or hands off or, fully in control important to me, is going to help you decide, hey, I'm going to see a lot of investments these next few days, and this is going to help you decide what's right for you. So I normally spend an hour going through this chart, but I won't. What we're going to talk about today is apartment syndications. And so I'm going to go through the structure of a multifamily syndication because that's what I do. But know that this structure can be applied to any syndication. So it can be applied to mobile home park. It can be applied to storage units. It can be applied to a fund. It can be applied to medical office retail park. So if there's an asset class that you like and you want to be involved, but you want to be hands off, you're going to want to pay attention right now. So in a syndication, the investors are not on the loan. The investors are not on the deed. And the investors don't have to do any work. The tenants do not know who the investors are. So those are all the benefits. You're not in control. So you have to be, trusting of the people who are in control and doing this for you. But here's an example with some numbers. Say we're going to buy this apartment building for $1 million. That would be quite a steal, wouldn't it? I wouldn't give any of it to you guys. I would do it myself because that would be a really, really great deal. But say we want to buy this. And it's $1 million. So we go and get a loan, me and my business partners, and then we need a down payment. So we would go out to investors like you guys and say, hey, here's our business plan. Here's our model returns. Do you want to invest? And what we do is we create an LLC. And the sole purpose of that LLC is to run this apartment building. So this apartment building has its own accounting. It has its own entity. It is not commingled with other apartment buildings or, my business funds or anything like that. It is an individual LLC that owns and runs this apartment building. Okay. And so in order to make the purchase, the capital stack is split a certain way, and then the equity and ownership is split a certain way. And it's really important to understand. I'm going to show you a model, but each syndication will have different numbers. I chose easy numbers for display purposes, for teaching purposes. Okay, so general partners in the LLC, that would be like me and my partners. We're the ones who, again, are on the loan. We're the ones who do all the work. We're the ones who manage the property management company, set up the LLC, do everything. Now, the limited partners put their money in and then stand back and get quarterly checks. They do nothing else. Okay, literally, you do nothing else. You just get quarterly checks. And, you need to file your taxes once a year too. Okay, so where does the money come from and how do we break it down? So the capital to make the purchase, if all the capital, this pie represents all the capital needed, we get some of the capital from a loan. That's the gray part. We put in some of our own money, and then we go out to investors and raise capital. So say 30% of the cost to acquire this comes from limited partners, comes from individual investors. Okay, so investors put in this example, $300,000. How does the ownership work out? So if this is 100% ownership of the LLC that holds the apartment building, this is how we break it down. So you see that the two green pieces of pie are not the same. And this is really important to understand because this is how you can get really strong returns, is that you get 70% of cash flow and 70% of capital gains at the exit. So that's how the exit returns for investors can be really strong, because you're not simply getting, hey, you provide 30% of the purchase price, you get 30% ownership. No, for 30% of the purchase price or the cost of acquisition, you get 70% ownership of the LLC that owns this apartment building. So as we're executing the business plan over the next 3, 4, 5 years, whatever it is for the individual opportunity, it's increasing the net operating income. Business plan is increasing the net operating income. And an apartment building held in an LLC, it's a business, right? And businesses are bought and sold according to net operating income, EBITDA. They're not emotional buys the way that single family homes can be. They are not volatile the way that single family homes can be as far as pricing. There are some levers that are pulled, like what's going on in the lending market, that affect purchase price. But the main consideration when buying and selling apartment buildings is it's a business. What's the net operating income? So we execute all that on behalf of investors so that when we exit, we have oftentimes we sell it for twice what we bought it for, and then investors get a 70% of that capital gains, and that's how they get to the really nice 33% annualized returns. Okay, so terminology. Okay, I'm going to close the blinds because the sun just rose over here in case you guys can't tell. And it's coming right in my window in my eyes. Let me just. All right. Good morning. Okay. So cash on cash. So this is like if you have a single family home rental and you get monthly checks from that, and that up, subtract all your expenses. What is this, compared to the money that you put in? I encourage you all to take a look at your cash on cash return for all of your investments, especially right now, especially today. The markets are going crazy, crypto is going crazy, and the real estate market's going funky too. So really take a look at whatever investments you have, get to know them. I know Scott does this with you. So for the new people, if you're not doing this, please do this, because I talk to investors all the time who are like, I think it's pretty good. I'm getting like $1,000 a month. And then we look at that on a cash on cash return and it's like 2 or 3%. I'm like, that's not good. That's actually very bad. That's a bad investment. I would say 2 or 3% per year. There are so many things where you can get 8%, 10% cash on cash, and you also are getting, appreciation and stuff like that. So I encourage you all, as part of this event, being part of it, that you get really clear and you look at your IRA, your 401k, how is it doing as far as cash on cash? Also, when you see syndications, there's going to be something called an annualized return. And so what that means is, hey, if you include the cash flow and the appreciation on the back end, what is that for investors? And so that's going to be different than your cash flow. So if you're investing with, for the future, for like 10 years from now, I say pay attention to the annualized return. That's the most important number for you. All right, in the interest of getting to due diligence, I'm going to skip through this since most of you said you know what syndications are. You probably know the rest of these. So for those of you who are new to syndication, though, I'll show what this means. So if it's a 5-year hold on an investment and you put in 100K and it has 8% cash on cash and 20% annualized. So this is the investment in the previous slide. This is how it would play out. You get your 8% per year, which is $8,000 per year. Great, but you're not retiring on this. But then when the investment is sold, proceeds from sale, so this is your capital gains, your 70% of the appreciation, may get a check for $60,000. And then of course you get your 100K returned to you, your principal investment returned at the exit. Now this is important to know on each investment what this waterfall looks like for you, and is their principal investment returned on the back end. So for instance, Dave Zook is going to talk, I don't know if it's today or another day, but when I first started looking at his investments, they're 25% cash flow. And I was like, this is a no-brainer. I'm putting all my money in. Well, principal investment return on the back end is not 100% of what you put in. It doesn't mean it's a good or bad investment. It means be aware of how the money plays out so you can make a responsible decision. I still put money in there from my fund, knowing that on the back end, if I put in 100K, I wasn't getting 100K back. So really know all these pieces so that when you make an investment, you're not surprised. So you're entering it eyes wide open and making sure it's right for you. So in this syndication example, you get 40K of cash flow over 5 years. You get your 60K, which is your portion of the appreciation at sale, get your 100K back. So on this, you would have turned your 100K into 200K. So this is a really simple model using round numbers, but this is actually very common in syndications. And so if you're looking at syndications and it's not at this level, keep looking, because there are a ton of people, not just me, but a ton of people out there who double investor money in 5 years or less. And that is their goal and their track record, and they love doing this. Now, a cool thing as well about syndications is that there's a tax advantage. So I just showed the money that you received, but hey, you probably got to pay taxes on your income, right? Well, it depends on how you're holding the investment. So you might hold it in your IRA, your 401k. That's going to be taxed different than if you're holding it in your trust or one of your investment LLCs, one of your holding companies. And your passive and your active income, this would be considered, if you're not a real estate investor, passive income and capital gains. So there is an advantage. And oftentimes for 100K investment, we're seeing between 30K and 100K of depreciation and loss that's passed through to investors in that first year. So again, the structure is we have an LLC, and the LLC holds the apartment building. Any depreciation and loss from that real estate, it passes through to the LLC and passes through to the investors. So there are a lot of things that people do to play with this type of investing in their tax planning. Okay, so if you look at this and you're like, yeah, syndications seem great. How do I get started? Well, you need to know how to evaluate them. And oftentimes people start by looking at an investment, like looking at the numbers, looking at the marketing plan, the marketing material that's out there. And they spend a lot of time going through the numbers and deciding if they want to invest. And that is backwards. You know what VCs, like really successful VC firms do? Do they start by looking at the numbers of the business plan? No, they start by looking at the people involved. So they bet on the jockey, not on the horse. You've probably heard that. but every successful investor, whether it's VC, if it's, betting on horse races, if it's in real estate, people make or break everything that you can earn. And so you actually want to start by doing your due diligence on the people involved. So when you're going into a syndication, there's going to be a lot of people involved. It's not just one person. There's the property management team. There's, the attorney, the CPA. There's so many people involved. So you want to Google them. You want to do background checks. You can ask for track records. Veravest.com is a really great resource for all of you on here. I would write that down. And you're going to want to learn how to read a PPM. You're going to want to learn how to read the waterfall, which is basically how are the returns paid? Are the investors paid first, or are the general partners paid first? You want to know that, not just what does it say on the marketing material, but in the PPM that you're going to sign. How are the taxes and the depreciation and losses allocated? It's different for every fund and every manager. So I think you're going to want to do due diligence on the market. And I have a checklist I'll show you in a bit, but you're going to want to take a look at everything that's going on in that market and compare it to what's going on in the United States. So and this is even more critical in the last 2 years. It's gotten more and more important because people move so quickly now. So human migration patterns, like the speed to migrate, has been cut in half over the last 2 years. People move so quickly. You can see the reports that are put out by all the moving truck companies. You can look at ingress and egress data for cities. And so that really gives you a strong sense of, if you have real estate, you have a product that you need a huge amount of people to be physically present for. So you're going to want to see, is the population growing compared to the US, meaning people are moving there? Are jobs growing compared to the US? All these things, I'll give you a checklist. And then lastly, you're going to want to look at the property. So follow someone who you really resonate with, that they're solid in their due diligence and their business ethics. Choose a market that they invest in that's one that you can really hone in and identify with. And then lastly, when they have something that they offer to you, an opportunity to join, then lastly, take a look at that. Don't do it backwards like so many people do, and then they get in trouble, because then they go, oh, it looks so good, and I didn't realize this person was a scam. I hear so many scam stories, you guys. Okay, so most importantly, I would say when you're doing your due diligence for people, ask for their track record, okay? So if you guys want to email me, ask me for my track record, I have every single property I've ever owned, the target returns for investors and the actual return for investors, where is the property located, the number of units in that property, and the price of that property. That's going to help you determine if what I'm offering you, I already have experience doing that asset class, that size in that market, and what are the returns I've gotten for investors. So, just me saying, hey, I got 33% annualized for investors. What if that was all in storage units? And now I'm presenting a multifamily offering to you. It's different. Storage unit doesn't have people living there. There are different rules to multifamily. And so if I have no experience, it doesn't mean don't invest with me, but it means, hey, pay attention to make sure that you review the track record very thoroughly, and that the asset class is aligned, the size is aligned, the dollar, size is aligned, and that the market is aligned. Like they already have experience in all those things. Unless you know them very well and you're like, I'm going to bet that they can pull it off in this area as well. All right, market. So here's a checklist. You can take a screenshot, or, if you're recording, take a screenshot. These are things that you can just Google, and these are really important things before you choose a market. So whether you're looking at a syndication, or if you're looking at single family home rental, Airbnb, you're still going to want to look at all of this information. I'm going to take a sip real quick. Okay, so like I said, you're going to want to look at the population, and there's no set number around population because it all depends. So if the population in the US is growing at, let's say, okay, I'm thinking of investing in San Francisco where I live. I look at population growth over the last 2 years and what it's projected to be over the next 2 years. And it says 1%. Does that make it an attractive market or not attractive? Well, it depends. What's going on in the US? Oh, the US population growth is -2% and San Francisco is 1%. Well, that's 3% higher than the rest of the United States. It means people are going here to this market I'm thinking of. That's great. If the population growth in the US is 5%, and in San Francisco it's 1%, it means people are leaving San Francisco. Not a great market to try to build out supply in. So all these things in your checklist, job stability, job growth, household growth, income growth, vacancy rates, market rents, all these things, you want to look at those numbers and compare them to the rest of the US to let you know, is this a market that has more people, more jobs, more income, which equals more demand for what you're supplying, which is real estate? Or is it going the wrong way? Is it, opposite trend of what's going on in the US? And then I would say, pick a different market. Don't choose that one. Okay, cool. I'll go ahead and wrap it up and just say, when you're looking at then the property level, you want to take a look at what's the property doing compared to what's going on in the rest of the market. So, like when you're looking at a city, you compare all the data to the US. When you're looking at a property, compare those numbers to what's going on in that city. So vacancy rates, rent, etc. And that's going to tell you, can this business plan be really profitable for me or not profitable for me? Because just straight looking at the numbers don't tell you the full story. You need to compare it to what's going on in the market. And that's going to tell you how much you can raise the net operating income of that investment and increase your profits.